Choksey also joins us on the show right now. The point that Aisha was making, it's a portfolio which is bleeding today because quality names that were part of many portfolio are getting undone. What should one do? Sell out of some of these names and book whatever profits you have, or just ride it out? Some of these names like Dixon, Zomato might have a good future when you look at the medium term horizon. Deven, I can't hear you. You'll have to unmute yourself.
Yeah, good afternoon, Anisha. Well, I think we have always maintained that companies, consumer tech companies like Zomato, or even EMS companies who are into the manufacturing of the consumer durables like Dixon, they are all fantastic companies. They have got a good business visibility too. However, everything is built into the price, and the price is basically discounting the future, at least I think, if not more, 2.5 to 3 years ahead of time. Now, if you are basically going to pay the price today for the performance of the company, which is going to come in 3 years from now, certainly, I think on a quarterly to quarterly basis, I think whenever you review the performance of the company, any small disappointment, I think, would probably cause a big amount of damage to the price, as we are seeing in both these companies. In my viewpoint, nothing wrong with the businesses, but the fact is that I think these companies can underperform big time if they are expensively traded and continue to be bought expensive. So, in my viewpoint, I would not be very keen to buy them unless I think a meaningful valuation correction takes place into these companies.
Interesting. So, at what level, Deven, would you say that Zomato becomes a buy? And what valuations would you be comfortable ascribing to the stock, given that the management itself is talking about almost a year or over kind of losses in the quick commerce business?
So, Aisha, I think generally, I think the rule applied here is, and that is a basic rule that we apply, that as much as the growth of the company is, I think if that particular premium is given to the future valuation, then it is justified. Here in these cases, I think some of these companies are actually traded at higher than the growth. It is, I think, 5 to 6 times growth valuations in many cases. So, in my viewpoint, I think that is a problem. Unless and until that gets rationalized. Now, either the rationalization can happen through price correction, or normally it happens that I think some of these companies would have a longer time correction, and that time correction can frustrate investors as far as the return is concerned. So I would always believe that I think as long as the growth is given a premium, that is justified, but I think that too in a rational manner for 1 year or so. If you give 3 years in advance, certainly I think there is no justification on that particular as well.
Right, interesting. That's the take on Zomato.
Hospital names, Apollo Hospitals, Max Healthcare, they're holding to the green in an otherwise weak market. Would you buy any of these names, or they still look very expensive to you?
They are all expensive. I think the same argument goes to, I think, these companies as well. Though I agree that I think this is one sector where larger amount of investors interest is, and I think some of the large investors are putting money behind these companies, so that I think that money can also get used for the purpose of expanding the new rooms capacity that these hospitals are talking about. So that is justified. I think they are basically putting money behind the growth. But if you are to buy a fresh, and if you are a minority shareholder, certainly I think you are buying very expensive proposition. I don't know, I think, how much time and price correction this particular companies can give, but the fact remains that I think they're expensive. So I think buying them at this expensive level could possibly invite for a larger amount of underperformance in your portfolio.